The luxury fashion industry is experiencing a seismic shift unlike anything we have seen before. Once untouchable brands that symbolized wealth, exclusivity, and status are now facing unprecedented financial challenges. Today, we are diving into 15 luxury clothing brands that are hemorrhaging billions at an alarming rate. What is particularly fascinating is that this is not just about the pandemic aftermath, it is a perfect storm of changing consumer preferences, digital transformation failures, and strategic missteps that have left even the most established fashion houses vulnerable. Let's start with Burberry, the iconic British luxury brand known for its distinctive check pattern and trench coats. Burberry has seen its market value plummet by over $2.3 billion in the past year alone. The brand's attempts to reposition itself under new creative director Daniel Lee haven't resonated with consumers as expected. Their latest quarterly results showed a 10% drop in comparable store sales, with particularly concerning performance in the crucial Chinese market, where sales declined by 15%. Burberry's struggle highlights a broader issue facing luxury brands: the delicate balance between heritage and innovation. Push too far in either direction, and you risk alienating either your loyal customer base or failing to attract new consumers. Next up is Kering, the luxury conglomerate that owns Gucci, Saint Laurent, Bottega Veneta, and Balenciaga. While the entire group is struggling, Gucci is the most concerning component. Once the darling of the luxury industry under creative director Alessandro Michele, Gucci has seen its sales decline by 18% in the first quarter of 2025. This represents approximately $1.8 billion in lost revenue compared to its peak performance. The brand's maximalist aesthetic that once captivated consumers has fallen out of favor, and its transition to a more timeless approach under new creative director Sabato De Sarno hasn't yet gained traction. Kering's market capitalization has decreased by nearly $25 billion over the past 2 years, making it one of the worst-performing luxury stocks. Balenciaga, another Kering brand, deserves special mention. Following a series of controversial advertising campaigns in late 2022 that appeared to sexualize children, the brand faced intense backlash. This PR disaster, combined with creative director Demna Gvasalia's increasingly polarizing designs, has resulted in an estimated 20% drop in annual revenue. The brand that was once considered the coolest in fashion is now struggling to rebuild consumer trust and relevance. Moving on to Prada, the Italian luxury house has experienced a 12% decline in sales in the first half of 2025, representing approximately $400 million in lost revenue. While Prada's sister brand Miu Miu has been performing exceptionally well thanks to viral micro-mini skirts and ballet flats, it hasn't been enough to offset the decline in the main line. Prada's attempts to reduce its reliance on wholesale channels and focus on direct-to-consumer sales have created short-term pain that investors are struggling to look beyond. Ralph Lauren, once the definitive American luxury brand, has seen its market value decrease by $1.2 billion over the past year. The brand's identity crisis, trying to maintain its luxury positioning while still operating numerous diffusion lines and outlet stores, has diluted its prestige. Ralph Lauren's revenue in the luxury segment specifically has declined by 8% year over year, as consumers increasingly question whether the brand truly belongs in the luxury category alongside European powerhouses. Salvatore Ferragamo, the Italian luxury shoe and leather goods brand, has experienced one of the most dramatic declines. The company's market value has decreased by over 40% in the past 2 years, representing approximately $1.5 billion in lost shareholder value. Ferragamo's inability to attract younger consumers and its over-reliance on formal footwear in an increasingly casual world has left it struggling to find relevance. The brand's attempts to revitalize under creative director Maximilian Davis have yet to translate into financial results. Tod's, another Italian luxury brand known for its driving shoes and leather goods, has seen its revenue decline by 11% in the past year. The brand's focus on timeless, understated luxury has failed to generate excitement in a market increasingly driven by viral moments and social media presence. Tod's has recently been taken private by the founding family and LVMH, a move that acknowledges the significant restructuring needed away from public market scrutiny. Hugo Boss, the German luxury brand, has experienced a 15% drop in its share price over the past 6 months, wiping out approximately $800 million in market value. The brand's attempt to reposition itself with a more youthful image and separate Boss and Hugo lines has confused consumers and diluted its identity. Hugo Boss's formal wear heritage has become a liability in a post-pandemic world where dress codes have become increasingly casual. Brunello Cucinelli, often considered the king of quiet luxury, has seen its stock decline by 18% in 2025, despite being perfectly positioned for the current trend toward understated wealth signaling. The brand's extremely high price points have become difficult to justify even for wealthy consumers in an inflationary environment. With cashmere sweaters starting at $2,000 and simple t-shirts at $700, the brand is testing the limits of what even the affluent are willing to pay for basics. Richemont, the luxury conglomerate that owns Cartier, Van Cleef, and Arpels, and numerous fashion brands including Chloe and Alaya, has seen its fashion division struggle significantly. While its jewelry houses continue to perform well, Richemont's fashion brands have collectively seen a 14% decline in revenue, representing approximately $600 million in lost sales. The company has been unable to replicate the success of its hard luxury businesses in the more trend-dependent soft luxury segment. Capri Holdings, which owns Versace, Jimmy Choo, and Michael Kors, has seen its market value decline by over 30% in the past year, representing approximately $2 billion in lost shareholder value. The company's attempt to elevate Michael Kors into the luxury space has largely failed, while Versace and Jimmy Choo haven't grown quickly enough to offset this decline. Capri's recent acquisition by Tapestry, owner of Coach and Kate Spade, signals the end of its independent luxury ambitions. Burberry isn't the only British luxury brand facing challenges. Mulberry, known for its leather goods, has seen its revenue decline by 17% in the past year. The brand's attempts to position itself as a more accessible luxury option have backfired, as consumers increasingly gravitate toward either true luxury or premium contemporary brands, leaving Mulberry caught in an uncomfortable middle ground. The company's market capitalization has decreased by approximately 40% over the past 2 years. Ermenegildo Zegna, the Italian luxury menswear brand that went public via SPAC in 2021, has seen its share price decline by 25% since its listing. The brand's focus on formal menswear has become challenging in a post-pandemic environment, and its attempts to diversify through the acquisition of Thom Browne haven't yet delivered the expected results. Zegna's revenue has declined by 7% in the past year, representing approximately $150 million in lost sales. Moncler, the Italian luxury outerwear brand, has seen its stock decline by 20% in 2025, despite being one of the most successful luxury stories of the past decade. The brand's heavy reliance on a single product category, luxury puffer jackets, has become a vulnerability as climate change leads to milder winters in many key markets. Moncler's attempts to diversify beyond outerwear haven't yet gained significant traction with consumers. Finally, Bally, the Swiss luxury brand known for its shoes and accessories, has seen its revenue decline by an estimated 15% in the past year. The brand's lack of a clear creative direction and identity has left it struggling to stand out in an increasingly crowded luxury marketplace. Bally's parent company, Jab Holding, has reportedly been exploring options to divest the brand after years of underperformance. So, what's behind this widespread decline in the luxury fashion industry? Several factors are converging to create a perfect storm. First, the post-pandemic luxury boom has definitively ended. During 2021 and 2022, luxury brands benefited from pent-up demand and consumers redirecting travel budgets toward tangible goods. That exceptional period has now normalized, leaving many brands with unrealistic growth expectations. Second, the Chinese consumer, who has driven much of luxury's growth over the past decade, is pulling back. China's economic slowdown, youth unemployment, and property market challenges have led to more cautious spending. Additionally, Chinese consumers are increasingly supporting domestic luxury brands rather than Western ones, a trend accelerated by rising nationalism and geopolitical tensions. Third, luxury brands have failed to adapt to the digital transformation at the pace required. While e-commerce adoption was accelerated during the pandemic, many luxury brands still treat their digital channels as secondary to their physical retail experiences. This approach is increasingly out of step with how consumers, particularly younger ones, want to engage with brands. Fourth, there's been a significant shift in what consumers value in luxury. The ostentatious logos and conspicuous consumption that drove luxury growth in the 2010s have given way to a preference for understated quality and sustainability. Many brands have been slow to adapt to this shift, continuing to rely on logo-heavy products that no longer resonate with evolving consumer preferences. Fifth, the rise of the second-hand luxury market has created unprecedented competition for new products. Platforms like The RealReal, Vestiaire Collective, and even eBay have made it easier than ever for consumers to purchase pre-owned luxury goods at significant discounts. This circular economy is particularly appealing to younger consumers who are both price-sensitive and environmentally conscious. Sixth, luxury brands have struggled with the tension between exclusivity and growth. Public markets demand continuous expansion, but true luxury requires scarcity and exclusivity. This fundamental contradiction has led many brands to overexpand, diluting their prestige in pursuit of quarterly results. What strategies are these struggling luxury brands employing to reverse their fortunes? Some are doubling down on their heritage, focusing on timeless products rather than chasing trends. Others are attempting radical reinventions, bringing in new creative directors and completely overhauling their aesthetic. Several are investing heavily in digital transformation, recognizing that the luxury customer journey now spans both physical and digital touchpoints. Many brands are also reconsidering their pricing strategies. After years of aggressive price increases that far outpaced inflation, some luxury houses are holding prices steady or even introducing more accessible entry-level products to attract new customers. Others are going in the opposite direction, elevating their positioning even further to target ultra-high net worth individuals who remain insulated from economic pressures. Sustainability has become another key battleground. Brands like Kering have made significant investments in sustainable materials and transparent supply chains, recognizing that today's luxury consumers increasingly demand ethical production. However, these investments are costly and often take years to deliver tangible results, creating short-term financial pressure. The luxury fashion industry is also seeing unprecedented consolidation. LVMH, despite its own challenges, with brands like Louis Vuitton and Dior experiencing slowing growth, continues to acquire struggling independent luxury houses. Kering is reportedly looking for acquisitions to reduce its reliance on Gucci. This consolidation is likely to accelerate as smaller luxury brands find it increasingly difficult to compete independently. What does this mean for the future of luxury fashion? The industry is likely entering a period of significant transformation. The brands that will emerge strongest are those that can balance heritage with innovation, exclusivity with accessibility, and physical retail excellence with digital transformation. They will need to create genuine connections with consumers based on shared values rather than just status signaling. We're also likely to see a clearer separation between true luxury and premium brands. The masstige segment, mass prestige products that mimic luxury at more accessible price points, is particularly vulnerable as consumers become more discerning about what constitutes genuine luxury. For consumers, these changes present both challenges and opportunities. On one hand, the democratization of luxury through secondhand markets and digital channels means that more people than ever can access luxury products. On the other hand, true luxury may become even more exclusive and expensive as brands focus on their highest spending clients. For investors, the luxury sector no longer offers the reliable growth and margins it once did. Selecting winners will require a nuanced understanding of brand equity, digital capabilities, and changing consumer preferences rather than simply betting on the sector as a whole. The luxury fashion industry has weathered many storms throughout its history, from world wars to economic depressions to changing social attitudes toward conspicuous consumption. The current challenges, while significant, are unlikely to spell the end of luxury fashion. Instead, they will accelerate an evolution that was already underway, separating the truly innovative and adaptable brands from those relying too heavily on past glory. What's your take on the future of luxury fashion? Are you still willing to pay premium prices for luxury brands, or are you exploring alternatives like secondhand luxury or premium contemporary brands? Let me know in the comments below, and don't forget to subscribe for more insights into the business of fashion.